Despite the recent rotation out of tech, my next guest still sees opportunity there. So joining me now is Matt Miskin, co-chief investment strategist at Manulife John Hancock Investments. Matt, it's great to have you on, and let's start right there. What do you think of stocks at these levels, and where do you think we go from here?
Yeah, Morgan, today's a day that reminds you that the market was really looking forward to some rate cuts. And the thought that the economy is actually accelerating here into August based on the PMI data is causing a bit of a sell-off. But in our view, there's value to be had in some of the names that are being sold off, as high-quality stocks have been the laggard. We actually think they're going to be making a comeback in the back half. We think they've been underappreciated in terms of earnings growth this year. A lot of capital has chased momentum stocks this year. We would move back into quality, use that strong balance sheet, high ROE, good profit margins to get you through this volatility.
Where do you see quality? What will you define as quality?
Yeah, so technology always has been the poster child. I mean, the earnings growth, the balance sheets, the profit margins, it has it all. The valuations are rich, but the earnings growth is of the best in the world. And then communication services, similar story. We also are looking at industrials. You can find high quality industrial companies benefiting from the onshoring CapEx boom we're seeing across the country. So those three sectors are really our favorites. But what we're seeing more broadly is a market that's tapped out in terms of multiple expansion. And we're looking for companies that could deliver earnings growth to us. And that's going to be the key driver of returns from here, is really earnings growth.
So in light of that, U.S. versus the rest of the world, what do you think?
So this is on tap for one of the best years in Europe's history in terms of markets. It's been quite a counterintuitive years. You would have thought tariffs would have caused non-U.S. markets to struggle. They are having the best year ever. And you really want to look at the fundamentals, though. Earnings growth outside the United States, in terms of the EFA at least, is tracking about 3% this year. The S&P 500, it's over 10%. We are not seeing this loss of exceptionalism here in the United States. The PMI readings today for August just showed the U.S. came back swinging in terms of the soft patch that had been developing at the start of the summer. U.S. earnings power is the best in the world. Yes, there's a valuation gap, but the thing is, Europe has rallied all on multiple expansion, all on valuation re-rating. We think that's starting to get tapped out.
Okay, so if I look to tomorrow and Fed Chair Powell's speech at Jackson Hole, there had been an expectation that maybe he'd tilt a little more dovish. Now, maybe not so much. What are you anticipating? Do you think September is live for a rate cut here, or could inflation be stickier?
Yeah, we do think September is going to be a rate cut, Morgan. But what we are seeing today was a good microcosm of the torture that the Fed is going through. So we got initial jobless claims higher, and continuing claims are at all-time cycle high. Philly Fed missed, and then the manufacturing PMI and services PMI boomed. What you make out of all that? Hard to say. It's all over the place. And so as the Fed is trying to navigate this, it is not giving them much confidence going into the September meeting. I think that the market's already set on a September cut, but October and December are still up for grabs. And that's why this market is a little choppy here, because if those aren't going to be cuts, we think that the market multiple might come down a bit. You got to hold on the higher quality strong earnings companies to get through that.
All right. So what does that mean for fixed income as well? Do you see compelling investments to be made there?
Yeah, we do. I mean, at the end of the day, we have broadly seen disinflationary forces. Housing data just came out today. Inventory's up 15%. We're seeing nationally housing prices decline outright. So declining housing prices. We've got oil prices that have been contained. Commodity prices are down, generally speaking. And then wage growth is slowing. Indeed came out with some wage growth data. Wage growth is slowing. So we're seeing disinflationary forces across the board. And really, it's just the tariffs that are causing inflation. But all these other things should be disinflationary enough to get the Fed to be able to cut more so in the back half or into the final quarter here. That's one thing we think will end up materializing. But we are in a tough spot because the next month, it is giving a mixed emotions or mixed picture. And we just got to be, careful here, not adding too much risk, letting the market settle out. And then we think actually in the end, the Fed will cut. That should provide a bit of a slowdown or a stop of some of this downside.